Walking into January 2026, the global economy braced for a hard landing. Between heavy trade protectionism, retaliatory tariffs, and volatile energy markets driven by Middle East conflicts, a severe crash seemed likely. Yet global GDP held surprisingly steady, hovering at a resilient 3.1% growth rate. This map breaks down that 3.1% global baseline and shows a massive regional divergence. The United States charted a steady 2.3 to 2.4% growth trajectory. India surged to a spectacular 6.5 to 6.7%, fueled by a heavy influx of venture capital. Meanwhile, Europe sputtered, stalling between 0.5 and 1.7% due to high industrial overhead and severe energy constraints. The countries that thrived had one specific thing in common. They became massive safe havens for technology capital. Investors aggressively parked their money in American tech infrastructure and Indian decentralized tech hubs to avoid the volatility of traditional industrial markets. By mid-year, technology provided the structural rigidity that kept the global economy from buckling. It had integrated into the foundation of the macroeconomy, serving as its primary engine room. Inside that tech sector, the first half of 2026 became known as the Year of Truth. The industry stopped tinkering with small artificial intelligence software prototypes and started pouring physical concrete. We can see the scale of this build-out by looking at this bar chart comparing tech capital expenditure from 2025 to 2026. The top 5 tech hyperscalers, Amazon, Microsoft, Google, Meta, and Oracle, committed to an astronomical $600 billion in hardware spending. That is a 36% vertical leap in a single year. Out of that total, a massive 75%, roughly $450 billion, was earmarked exclusively for purpose-built AI infrastructure. Code scales infinitely, but concrete does not. This massive capital injection locked an industry built on limitless software ambition onto a high-speed collision course with the finite resources of the physical world. In January 2026 alone, United States tech firms dumped over $25 billion into just 20 mega data center construction sites. For context, they spent barely a tenth of that in the same time frame 2 years prior. This building frenzy triggered a severe real estate shock. The cost to construct these massive digital cathedrals skyrocketed to $488 per square foot. Once the walls were up, they needed hardware. Look at this pie chart tracking the global memory chip supply. AI data centers devoured hundreds of billions of dollars already to be spent, but the physical inability to forge the hardware fast enough brought deployment to a grinding halt. Chips and concrete were just the first hurdles. The ultimate choke point for the tech industry was the raw physics of power delivery. These new facilities require massive, continuous electrical currents to run and cool their servers. Global data center electricity consumption rapidly accelerated, racing toward a staggering ceiling of 1,050 terawatt hours. To understand that scale, look at this ranking ladder of national power grids. If global data centers were a sovereign country, they would consume enough electricity to take the number 5 position worldwide, easily outpacing mid-sized industrial nations. The artificial intelligence revolution hit a hard, physical ceiling. Future progress was no longer determined by the quality of the software engineers, but strictly governed by maximum electrical grid capacity. Heading into the second half of the year, investors adapted to this limit. Wall Street stopped rewarding speculative AI roadmaps. Capital valuations became strictly dependent on immediate financial yields. With hundreds of billions already sunk into the ground, tech giants faced immense pressure to prove actual enterprise execution and generate operational profit margins to justify the sunken costs. This bottleneck sparked a desperate clean energy gold rush. Hyperscalers realized they could not rely on choked, overburdened public utility grids to power their investments. Market dominance now requires securing independent energy supplies. The victors of late 2026 will be the companies that successfully lock down private nuclear facilities, solar farms, and smart grid contracts to bypass the gridlock. To survive the physical constraints of the real world, artificial intelligence developers were forced to transform into massive private energy procurement firms. Zooming out to the global stage, these physical constraints rippled outward. Facing 40-week hardware wait times and scarce electricity, nations began tightening their technological borders in response to the massive resource squeeze. Governments triggered intense defense mechanisms. They accelerated the construction of domestic digital public infrastructure and poured resources into local semiconductor manufacturing to ensure their data and hardware supply lines were entirely self-contained. This defensive hoarding permanently fractured the highly globalized, interconnected trade networks of the early 21st century. The race for artificial intelligence left the digital realm entirely. It shed its software origins and became the most expensive, high-stakes industrial war for finite physical resources in human history.